Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on gregschnell.com as well as stockcharts.com. So this week I thought I'd do things a little bit different. We have a market that's gone sideways really since April 16th. I recognize we're up slightly from that point in time, but we've bounced up above this to this level and pulled back before. So the real question is what's going on behind the indexes. And what I want to cover off today is the different types of breadth indicators, different ways to use the PMO, my strength indexes, a look at the McClellan oscillators. We'll see how many we can get through, but there's a few charts that really can help us understand what's going on behind the scenes in the market. So with that, I'm just going to focus today on breadth indicators and just show you why they're so weak and what we need to see to change that. So first of all, we have this NASDAQ advanced decline line, and it's finally starting to break out. So since the mid-February, so we had the February high, and since mid-February, we really haven't done anything. But the good news is we were on a downtrend and we've recently broken to the upside. So that's very bullish and very positive. We want that to continue. And it's this little piece of information that things are starting to improve on the NASDAQ that's helpful. When I look at the NASDAQ high-low data, this down here at the bottom, you can see we had roughly 250 net new highs. So that's net new lows minus, or net new highs minus net new lows equals how many this chart will display. So what we see here is 258, which is pretty good. But you can see in the heady run from November to February, we were racing along. The real information, though, on this chart is if we look back, and I mean, we're in a big bull run here, so lots of stocks are at all-time highs, so that's one of the reasons. But just if we open up this chart at all, we can see that 250, if we just put a line on there, is pretty much the sort of normal that we would have. It typically, the market, we've been riding up for years, but this 250 level is still a pretty high level. And so it doesn't mean the market's overbought, and it's nothing like that. When you're in a big bull market and stocks have started to make higher highs, this is the type of trade information you're going to expect, is that your high-low data is still pretty solid because the market is up near all-time highs. So that chart's telling us things are quite normal. Looking in on the advanced decline indicator, what we've got here is an uptrend from December. This is on the New York Composite, not on the NASDAQ. And what we see is this been trending higher and making higher highs. So that's very bullish. And the data on the chart itself, clearly everything's trending higher, and that's the way it should be. Now, one of the reasons that the difference for the New York versus the NASDAQ is the New York has a lot of financials and a lot of energy on it. And both of those are doing pretty well, and mining on New York. Whereas the technology names from the NASDAQ have been underperforming since February. And when that starts to change, we don't know. Well, we could find it out by charting, but what I would say is it hasn't started to change in a meaningful way yet. And so looking here at the New York advanced decline data down in the bottom right-hand corner, only 3 of the last 10 days have been negative, or 4 out of 15. It's pretty solid. There's no... that's a bull market. So that's very comforting. Now, when we go down to the high-low data for the New York, again, we're up at a very high level. And we kind of broke out to a higher level. What I was what these red bars are. They were noticing how muted the market was. And then in November, we saw this just kick right up. And of course, high-low data is always going to come later after a market rally starts than advanced decline data. So advanced decline says what are the numbers of advancers versus decliners, and the way I have it displayed on that other chart keeps a continuous tally. With the high-low, let's think about that. So the market pulled back really hard in 2020. So we're not going to have a whole bunch of stocks hitting new highs. And then once they start to hit new highs, that's kind of getting back into the normal bull cycle market. So we've had a really healthy run to the upside. And you can see this 500 level. We haven't seen that level in years. And that was just recent here. So very solid upside performance in May, and sometimes those spike highs can be a market overbought or whatever. I don't really, with the NASDAQ underperforming like that, it's not giving us those same clues. I hope that makes sense. So the big thing, the difference between the high-low data is it's late responding to a bear market. So coming out of the bear market, it's not going to fire up as quick. The advanced decline line fires up first. But as the rally goes on, what you've seen here is even though the NASDAQ still got a number of stocks making new highs, its advanced decline data had been flat for 4 months. So just those two things are quite helpful just to see what's going on. But here's the good news. Since the middle of May, the NASDAQ advanced decline line has been rising, and that's a really solid thing. So we want to be aware that it is improving. Now when we go to, this is a chart Arthur Hill first created, advanced decline percentage, and well, on StockCharts and where I got it from. This advanced decline percentage is pretty helpful, but this is for the S&P 1500. So the S&P 500, the mid-cap 600, and the small-cap 400. And what we see here is a continuous trend up. So this continues to say bull market ahead. And for the most important stocks around, that's a pretty helpful thing. And then when we look at the mid-caps just separately, we're still in an uptrend here. Everything's fine. It might have creaked a little bit below our line, but it's still okay. And then when we go to the small caps were actually going sideways for a couple of months, had clearly broken the uptrend, but now they're starting to break back out to the upside. So that's another reason that we want to be a little bit more bullish here as we go forward. When we look at just the S&P 500 for up-down volume percentage, what you can see is what you can see on the chart, stock market's moving up. Here's the S&P 500. The large caps have not really done much in the last 4 days, and of course the majority of the weight in the index is in the large caps. But the mid caps have spiked up yesterday, and on Monday, Tuesday, the small caps put in a pretty good showing. So there is some momentum building behind the market at this point, and more importantly than just thinking about it as the report for this day is to understand what the different data is telling us as we go forward. I should say are telling us as we go forward. So the high-low, this is from Alexander Elder, and it's a 5-day high-low. So what does that mean? Number of stocks making new highs over the last 5 days, all added up, minus the number of stocks making new lows. This is a pretty bullish reading. We're up in the 2,500 level. And just looking back at the chart here, that's pretty solid. So here's 2650. And if we just added a line to that here, so 2650, and you can see I've got it all set up so I can just add my lines whenever I want. But we're at a pretty heady level. It doesn't mean that we're overbought. Look at how the market topped back here in 2000, and we had very few. So you can see that we're still in a really solid market and it wants to go higher, and we're starting to see the conditions improve that help that. Doesn't mean it will end up going higher. What we need to see now is follow through. And so the Canadian market is much smaller, but it is metals, mining, oil and gas, and financials. So right now that's a pretty good sector, or pretty good grouping for Canadian stocks. And what you could see here is we were actually mired in the sideways movement March, April, May, and now we've broken out to new highs. So again, as energy started to get a new thrust with crude going above $70, this is starting to kick in. Okay, so let's go on to the McClellan oscillators, and there's some reasons to specifically look at these. So one of the things that the McClellan oscillator does is it tries to identify the overall momentum in the stocks, and by doing that you get this indicator that swings between minus 125 and positive 125. And then from this McClellan oscillator, and as you can see it swings wildly, but up at the top here is the summation index. And the summation index is like the cumulative version, so adding on each day to the day before to get a cumulative number. And this is a ratio adjusted. So the problem is, as the number of stocks change in the market over time, this would trend higher. So what they've done is they've used a ratio adjusted version to try and keep track of the changing number of stocks in the market at any given time. But you can see we had started to break this downtrend line, and now we're starting to tweak towards the upside here. We're still at a very bullish level, and what we want to see out of that indicator is that it continues to stay above 500. And recently we've dipped down, but again, the market hasn't really pulled back, so we're still okay. Now, when we look at the NASDAQ version of this chart, what you can see is from April of last year, we kept having lower highs, and we started to get below this 20 level quite consistently this year, and really haven't made any headway to the upside, and it started to move up. Now, what we see on the summation index is it's actually starting to pop to the upside. Recording this Wednesday morning before market open, so it's only been 2 days, and the summation index is still popping higher. But one of the things I like to notice is that as you go on these big heady runs up, and then what happens is the market kind of loses its momentum, and then starts to fall, and when it falls quite quickly. Now down around zero here, it tried to hold, but the two different charts are quite different. The NASDAQ, you can get to minus 200 and still be kind of an okay market. On the New York, it's positive 400 or 500 that I like to use as inflection points. So anyway, here's the minus 200 level, and you can see that's a really good place to expect bounces over time. And that's what we're seeing. So this big negative performance here on the McClellan oscillator has started to turn up. And if you want more information on each of these indicators, you can always go to the Chart School tab up here at one of the headers and just type in what you're looking for, and there's really good explanations of all of these. Okay, so that's pretty helpful. Now we also have things like the bullish percent index, and what do they talk about? So you need a fixed group of stocks. So in this case, it's the whole NASDAQ composite. And what we want to know is what percentage of stocks are on a buy signal. So let me just explain the P&F buy signal. So whatever, we take a stock, this one has no volume, it doesn't matter on a P&F chart, but whatever, let's just go with Apple. And what we see on this chart, obviously price is meandering sideways. So how does that look on a P&F? Well, you can go to the bottom here, and all of these different chart styles are available. And so this digit 1 here represents the first of the year, 2, 3, 4, 5. So we're in the 5th month. If the chart didn't move very much for the month, it could be that you actually don't see a number there. But in this particular case, here's 7, 8, 9, and then it goes A, B, C, and that's October, November, December. Anyway, the bottom line is Apple got to here last September, because you see the number 9, and started to push up. So it's sitting in a down row, but still, so the price is sitting here. This is the first change that happened in the month of May. And so what we see is the chart hasn't done anything for June, and we're sitting down in this lower level. Now, we could all draw a trend line up here. The way it's typically drawn automatically on a P&F chart is at a 45-degree angle. So even if you used 45-degree angle, we'd be connecting these O's and just saying if it starts to make another O here, we're putting this rally under pressure. And then when it actually drops below this last column of O's, that would be a sell signal. In this case, we're still on a buy signal, and the reason is because we've pushed up above the prior column of X's, but we haven't made a new low. Okay, so that's the real clue here, is how many stocks are on a buy signal. And again, Apple at $136 was on a buy signal. Apple down here at 126 or 124 is still on a buy signal. But if it started to move below the prior column of lows down here around 120, that would put it on a sell signal. The important thing to realize is there can be a wide range between buy signals and sell signals. Anyway, so what we want to do with that is then we check the whole group. So in this case, we've got all of the stocks on the NASDAQ, and what we see here is 63% of the stocks are on a buy signal. That's still very bullish. And the percentage of stocks above the 200-day moving average is around 61%. So looking into history, what we can see since 2002, and I have the bullish percent index back to late 1996, but I only have the percentage of stocks above the 200-day back to 2002. Anyway, you can see you go through these wild swings, and in early 2020, we were way down here. We've run up to the top, and we were up at 80% around the February high, and now we've pulled back to 50%. So that's quite a long ways down. I have placed these two red lines on here, and then normally what I do each week is I go in and I just type in the value of the closing number and put my green line on here, so that I can just use it as a reference point. And the only thing I would say is, in this case, market's holding up pretty well, but if all of a sudden the market was to start to take a meaningful dip below 55%, that's probably starting to get cautionary. And what you can see is some of the big sell-offs have made it up to here, or one of the big market rises have made it up to here and then sell off from below that. So just remember how many stocks there are out there, how many are on a buy signal, and again, it's a wide-ranging buy signal. But that's the good news. It's not finicky like a percentage of stocks above the 200-day moving average. Sorry, this is the above or below the 200-day moving average. It's one line in the sand. I cross-correlated there for a second. Your 60% level, so I update that each week. And then by putting that up here at 63%, we're very close to getting back to levels we were at since March. So if we could start to break to the upside, obviously that's positive. And again, that's a wide-ranging number. The percentage of stocks above the 200-day moving average is one single line, and you're either above it or below it. So it's finicky too, because it literally could change every day, whereas the bullish percent index typically doesn't. The stock has to move such a long way to make that happen. But in this case, both of them are still sitting very healthy. Anyway, I don't want to see the percentage of stocks below 50, and I don't want to see the bullish percent index drop below 50 either. And just typically 50% is a good bounce level. Okay, so that was a more descriptive version of what's on this chart. So percentage of stocks above the 200-day moving average, and then the bullish percent for the comp Q, and then the actual index to see what's going on. So you can see, even when the NASDAQ was having a heady run, the bullish percent index was swinging wildly. And that's because the stocks were really moving fast both ways. But then for the downtrend, most of the time we spent below 50% and the stocks just couldn't make any headway. And, you had rallies and then markets still giving back. So this clue here helps us a little bit. What we would have seen with the percentage of stocks above the 200 coming off the high is a lot of stocks dropped below their 200-day moving average and would have stayed down low for a while. Okay, so this is the NASDAQ 100, and I'm actually surprised how whippy this one is. We are currently at 75%, but as recently as the May lows, we were at 45%. The information on the chart basically tells us we're still plenty strong. I have my red zone here, the 70% line and the 80% line. Here's my indicator over here. So I've drawn these two lines in, just saying as long as it's above both of those, it's really healthy above 80. And above 70, it's still pretty strong. But again, the purpose of this lower red line is you can see when it starts to get weaker than that, that's a good place to at least be aware of the potential for big downside moves. We haven't had that. Okay, so again, you're looking for a different group. We had a group of NASDAQ 100. Now we have the group of the entire New York Stock Exchange. We're up here at 73%. We're above both the 70% and my lower limit, 65%. And then down here, we have 84% of the stocks above their 200-day moving average. That's really, really strong and helpful. So with so many stocks above their 200-day moving average, that means they're all in big uptrends. And then for the bullish percent index, what we're looking at is the vast majority of stocks are on a buy signal. And if anything, we've got a slight declining number of stocks, but still you're at a strong level. So more importantly than the slight decline is the fact that 75% of them are still on a buy signal and moving higher. Okay, so here's the S&P 500, and again, almost all of the emphasis or market cap is focused in the S&P 500. So that's the reason we focus on this market so much. Now, we're up at 90% of the stocks are above their 200-day moving average. The one thing that's important to note here is we have reached these levels before, and even if we took 2007, the market didn't top till late fall. And so what happens is this indicator has to decline quite meaningfully before you start to actually pull the market down. We're at a high level. The only thing I mentioned here is like after about 9 months, you start to not have enough strength to keep holding the new highs. So we want to stay focused on holding above the 200-day moving average. It's a helpful indicator. I think the more important thing to be aware of is the market has a lot of positivity built in, and the reason we're having trouble climbing out of this hole for the last 2 months is that the data has priced the investors have priced in the current strong data. So if you have strong data, investors are going to buy ahead of that. And as the market starts to weaken, they're long gone. They're starting to sell off. And so while they roll over on their bullish percent charts, you're going to see the big downtrend. So the bullish percent will typically weaken, and then it'll go from a very high level, like in 2018, it fell pretty much right away on the tariff announcements. It's those kind of clues that we get quite quickly. And you might remember 2018 was a year that we ended up down roughly 20%. So it was a more difficult year. Okay, let's go to the Toronto Stock Exchange and just briefly look at the data. again, a lot of energy, mines and minerals, and financials. So that makes up about 2/3, and tech is growing in Canada. There's a lot of nice tech companies that are out there. I think I've got a list of 50, but if you compare that to America, that list is pretty small. So we're still at 75%, very strong. 80% of the stocks are above their 200-day moving average. So all of that data transforms pretty well. Okay, so the only other thing that I wanted to show is we noticed that some of the charts are starting to improve. So I've created a couple of different strength indexes. And so for people who are members of GregSchnell.com, they get this all the time. But this one is kind of the slowest moving. At the time I labeled it based on the highs. And what you see here is this indicator's wobbling, and it's down in the bottom 25%. So not very strong. And it's supposed to give us advance notice on the way down. It'll probably move up when the market starts to move up. It's more timely. I used to just report it weekly, and now we've started to do it daily, so that's why the chart has taken on a new level of movement compared to historically. But it's still at a very weak level. We want to see this start to accelerate. So this one is quite a smooth indicator. If you look at this one is called my fast indicator, and it's just based on faster data, and what we see is it's actually climbing up quite rapidly, and we're really starting to see things improve. Now this one still has a smoothing on it of 3 weeks. So with that smoothing, what happens is as you go into a new week, sometimes it'll drop an old one and grab a new one. So it actually moves up quite quickly as the market starts to change. Now we haven't gone anywhere here, but the market's definitely trying. What we don't know is, will it just run up and fall back down? Well, these indicators will tell that. And I have one that I use that's unsmoothed, and this one's quite temperamental. And it's called the quick indicator, and it's really one of the ones that typically fires off first. In this case, it's second behind the fast indicator. But it's already turning up, and it's moving up meaningfully from this lower area. So with both the fast indicator and the quick indicator starting to move up and get out of the lower quadrant, that's quite bullish. And then when I stack all three of these together, you can see they're all starting to turn here, and the market's trying to make its rotation up. The real question is, can we break out? So based on what we've seen on the advanced decline line, it's pretty bullish. The strength indexes are going up. The McClellan oscillators are holding up and moving higher. Remember those summation index candles pushing up nice and high. So across the broad spectrum, things are really trying to improve. So if you like that kind of data, or you'd like I'll call it the simpler version of the strength indexes that I created, you could, if you're interested, and there's no pressure to do this, you could just go to GregSchnell.com, and from there you can see a whole range of what we offer, but we also have a plan in there. If you go to GregSchnell.com/explore, and what you'd find in there is a discount from the regular $860 to the $497 level. So at $40 a month, I think it's pretty good data, and it just helps you understand when to be really strong on the markets and when to be cautious. And most of the investors that follow me really appreciate the indexes, and they actually asked me to start going from weekly to daily because they found the indexes so much help. So hopefully that helps you as well. Thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays at 10:30 a.m. Eastern Time. You can also see the recording on StockCharts TV YouTube page or StockCharts on demand. Thanks everybody. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.